Hi friends, in this video I'm going to speak about 5 large cap companies, and the clear pattern in these 5 companies is that they are undergoing valuations correction at the minute. We are trying to understand the fundamental aspects of these businesses, their valuation correction reasons, and a lot more. Let's start with stock number 1, ICICI Bank. What you see on my screen is the price to book ratio of ICICI Bank, and if you look at the last 5 years median PB of this company, it is at around 3.1. The current PB is at around 3. It's below median. And in July 2025, if I go back and show you the data, price to book value of ICICI Bank was at around 4. So from 4, it has dropped to almost 3, which is 25% correction in the valuations. What's driving this correction? What's the long-term fundamentals of ICICI Bank? Allow me a couple of minutes of time so that you understand it completely. For this, what you need to look at first of all is the total deposits growth for ICICI Bank. And if you look at the last 4 to 5 years, it's grown at around 14.63% of CAGR basis, which is very, very healthy if you compare it with many other banking companies. If you look at the loan growth of the company, it's grown at around 16.29% CAGR basis between 2021 and 2025. So very, very healthy growth rate is what we have seen in the last 4 to 5 years. If I talk about the net interest margin of the company, 23 and 24 were the best years for ICICI Bank, where it was delivering a NIMs of around 4.48% or 4.53. It's come down in FY25 at around 4.32%. Maybe one of the reasons that the net interest margin has come down. We all know that the cost of funds have been going up. Maybe that is one of the reasons. But if you look at the asset quality of ICICI Bank, it has been consistently improving. In 2021, it was at around 1.1% of net NPAs. It's come down to 0.4%. That is phenomenal asset quality you can ever find in Indian banks. So, and that's not just with ICICI Bank, by the way. If you look at SBI's, HDFC's, every bank has been improving their asset qualities. Now, if I talk about the profit of ICICI Bank, standalone net profit growth rate between 21 and 25 has been around 38% CAGR basis. Extremely high growth rate in terms of the profit is what the company has delivered. Now, let's talk about FY26. Last 2 quarter results have come, Q3 results have not come. So if we compare H1 2026 and H1 2025, if you focus on these 2 columns and try to see if there are any fundamental problems with the bank. Okay, let's look at net interest margin, 4.31 last year versus 4.32, very stable. In fact, if you look at all these numbers, I'm not going to read it. I could not find anything that is materially degrading the company's fundamentals. For example, if you look at return on average assets, ROA, which is very important for a banking company, 2.38 versus 2.38. So all in all, I could not find any meaningful deterioration in the fundamentals. If you look at the NPA trend, as I talked about it, net NPA ratios have been improving quarter on quarter. If you look at the last few quarters, 0.42% tha September 2024 mein. As September 2025, it's in fact improved to 0.39%, right? If I talk about the loan growth rate of ICICI Bank, look at September 2025 versus September 2024. And if you look at the YOY growth, it's at around 10.3%. So definitely loan growth rate is softened a little bit. Ideally, you would expect ICICI to grow at, let's say, 12% above, 13%, 14%. Definitely in FY26, the loan growth rate has been softened 10.3%. That could be one of the reasons that I could distantly think that the valuations have corrected for ICICI Bank. But over the mid to long term, I really could not find any particular reasons that why the valuations have been correcting. In fact, 2 weeks back, I wrote a detailed commentary about this particular bank's insights that I'm sharing with you now. If you want to get these insights on daily basis, you can join my YouTube community. It's only for exclusive members. Almost on a daily basis, I'm trying to post there, giving you insights. I'm not giving any recommendations there. I'm giving insights so that you understand what is going on. The feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. With that, let's now explore company number 2. Second company that I want to speak about is Tata Consulting Services, TCS. What you see on my screen is TCS PE ratio. In the last 5 years, the median has been around 30.7. It's trading at around 22.9. So a massive correction, one would argue, from their median ratio. If you look at the price to book as well, very heavy correction here. It used to trade at around, let's say here, at around 18 back in September 2024. It's come down to almost 11 now. Of course, median is at around 13.4. Huge valuation correction in TCS. We all know why that has been happening. There is a question around the profitability growth of the company, the question around top line growth, 2%, 3% and whatnot. And more importantly, AI. Can AI take away all these jobs? That have been the question. TCS laid off a lot of people in the past. So all of that bad news have been baked into this valuation correction. Now, recently, just yesterday, Q3 results of TCS came out. Okay, and media was reporting this. What was media reporting? That the PAT of the company has fallen 14% year on year, which is technically true, but this is a headline number. What you need to do is go into a little bit of detail around their P&L. So what I did was I went through their P&L, okay, that they declared very, very recently. And what you note is profit for the period, definitely 10,720 crores versus September 2025. So sequentially it has dropped from 12,000 crore. And also if you look at year on year basis, it has also dropped from 12,444 crore. Now it has come down. But if you look at the profit before exceptional items and taxes, it's pretty good. I mean, it's not actually degrown. Okay, 17,469 crore versus last quarter was 17,203, and year on year basis, it's grown from 16,666. Again, I'm not trying to defend TCS, but I'm trying to give you insights here. What you note here is very quickly that the exceptional items are there, which are, for example, restructuring expenses, 253 crores, statutory impact of new labor codes that government implemented, 2128 crores, provision towards legal claims, 1000 crores. As per my understanding, all these are one-off, and these exceptional items have caused this PAT to fall. So if you ask me, has the fundamental degraded? No, absolutely not. Yes, the growth of the PAT and the top line is not yet there. It is definitely crawling at, let's say, 2 to 3%, whatever that number comes out. At the same time, what you need to understand is what is TCS's plan for the next 5 years. And a couple of points that I would quickly make about TCS's plans is, one of them is their AI revenues. So they have started talking about their AI services revenue, and it is standing at around $1.8 billion, which is up around 17.3%. So could AI give TCS more revenues, and can it propel the growth of TCS? That's the question that is out there. Secondly, if you look at the total contract value, the deal pipeline of TCS, still very, very healthy, $9.3 billion US. I don't think that's a problem for TCS. In fact, one of the bigger things that you need to notice about TCS is that very recently TCS published in the press release in November 2025 that they have signed a deal with TPG and TCS's Hypervault business, which is going to be data center business. They are going to put together 18,000 crores of money into this business. Now, could this business really scale 3 years down the line, 4 years down the line? That's where your bet needs to be when it comes to AI in data center. The normal bread and butter of TCS is definitely 2 to 3% of growth sort of a business. The growth could come only from AI in data center. And that's where this valuation correction that we have seen could rebound back if we see growth coming from AI and data center. Again, not a recommendation that you invest in TCS, but I hope you get this rounded view about the valuation correction, their latest quarterly results, as well as the future outlook in terms of their AI and data center. And if you like this, request you to hit the like button, subscribe to my channel, let me know in the comments a simple thank you. It motivates me to bring such content to you at zero cost. With that, let's also move to stock number 3 now. Third company that I want to discuss is Reliance Industries. If I talk about the PE ratio of Reliance Industries, last 5 years median has been around 26.2. At the time of recording this video, it is at around the same PE, median PE, 26.2. If you see the price to book ratio as well, the company's median PB has been around 2.1. It's at around 2.3 right now. It's corrected from almost, if you look at here, almost from 3 back in July 2024, right? Now, Reliance is such a big mammoth. If we try and look at different businesses that they have, oil to chemical and retail and geo and whatnot, what you need to understand is that in FY25, Reliance's business did not do well. Okay, so between April 24 to March 25, so here is the data that you can see. Reliance's energy business EBITDA was down by 8%. Okay, even Reliance retail hardly grew by 9%. Geo platforms, yes, 17% EBITDA growth, right? Overall FY25, if I talk about the PAT number, it only grew by 2.9%. And that's what you see immediately in the stock valuations. For example, if you look at the price, it dropped in FY25. It's a very, very clear pattern you see. The moment Reliance was not doing well business-wise in FY25, prices came down, the valuations corrected, right? That was the main reason. Now FY25 is gone, right? We are in FY26. Last 2 quarters, let me show you the performance of this company. So here, energy businesses, this is a Q1 FY26 data. Energy businesses EBITDA up by 7%. Okay. Look at Jio, 24% EBITDA growth. Look at Reliance Retail, from 9% in FY25, it's gone to like 13%. Okay. If I talk about overall PAT increase, 76%. Of course, there are some exceptional items in there. But if you look at EBITDA level, which removes all your exceptional items, it's at around 35% growth, which is what really mattered in Q1 2026. If I talk about Q2 FY26, here again, the business has recovered a lot. Energy business EBITDA 13% growth, Jio platform 18%, Reliance Retail 17%. All the businesses started firing in FY26, at least in the first 2 quarters. So one could argue that FY25, the fundamentals were not that great, but in FY26 first half, definitely there is a recovery in the businesses. And therefore, for example, if I talk about Q2 FY26, the PAT is growing at around 14% now. Q3 numbers have not yet come out, so I do not know what the numbers will be, but definitely earnings for Reliance in FY26 first half have been much better in FY25. And now the correction, this valuation correction, could it rebound back? We don't know. Again, depends on Q3 earnings, depends on a lot of market sentiments, what happens with US and India trade deal. There are a lot of other sentimental factors, but definitely Reliance's business has recovered in FY26 first half. Second half, we are yet to see. Valuations as of now, median PB, if you look at 2.1, it's at 2.3. PE ratio, if you look at 26.2 median, and it is at 26.2. Hope this makes a lot of sense to you. Please go and explore different businesses of Reliance's as well, so that you can do a bit more detailed analysis. Here I have only scratched the surface to give you the headline view. Okay, please don't take this as a recommendation. I hope you can go and explore Reliance Industries. Let me now move to stock number 4. Company number 4 is Varun Beverages Limited. What you see on my screen is P ratio of Varun Beverages. Last 5 years median has been around 63. It's come down to below that, 56.2. I mean, it used to be at around 100 back in July 2024. Valuation correction started since then, and it's come down to almost 55, 56 level. I don't know when you're watching the video. Please go and check the recent valuations. If I talk about the price to book of this company, again, it used to be at around 38 back in February 2024. It's come down to almost 9.1. Median has been in the last 5 years, 13.8. Huge correction in the valuations for Varun Beverages in the last 18 months or so. If you look at the profit and loss account of Varun Beverages, what you note is that it's still growing. It's still growing at a healthy rate. If you look at the top line, if you look at the bottom line, again, it's still growing at a healthy rate. In fact, trailing 12 month, it is sitting at the highest PAT ever, highest top line ever. So definitely it's not that the growth is not there. Yes, growth might have slowed down. The rate of the growth might have come down a little bit. But if I talk about the companies, for example, volume, it's very, very important to look at volume in FMCG businesses. If you look at the last 4 to 5 years, the growth has been there. Around 18% of CAGR growth rate is what we have seen. The blue bar you see is the Indian business, and the yellow you see is the international. I'll talk about international in a minute, because that's very, very important for Varun Beverages businesses, right? If I talk about why then valuations have corrected, in calendar year 2025, we all know that monsoon was heavy in India across the geographies. Now in 2025, what has happened is, because of prolonged rainfall, their Indian volumes did not grow a lot. Okay, international volume grew by around 9%. So Indian performance was subdued mainly, and therefore their fundamentals might got impacted a little bit in terms of the volume. That's what their chairman was saying. But if you look at the overall revenue and the PAT growth rate for 9 months of 2025, revenue grew by around 7%, while the PAT grew by 14.9%. Of course, you would like these revenues to go up by at least more than 10%. PAT 14.9%. So definitely there is some slowdown in the last 9 months, but could it bounce back? That's the question. And was it one-off because of the monsoon rainfalls that we've seen? Another interesting point that you need to know about Varun Beverage is that their margins have been improving. If you look at the PAT margin here, it has gone up to 16% here. As you can see, 9-month 2025, 16%. So continuous improvement in PAT margin is what we have seen. EBITDA also improving. EBITDA margins have been improving. So if you ask me, the margins are improving. Yes, the volume growth has not been there in the last, 8 to 10 months because of the monsoon in India. But what you need to know is more about their international expansion that I'll speak about in a minute. One of the other concerns that people had around GST framework. So new GST framework, what the company said is that around 1/4 of their portfolio, which is around juices, etc., there is a positive for company because GST rates have been reduced and they are going to get benefited. In fact, there was a detailed discussion done by CNBC and there was a post on LinkedIn. You can quickly go through this in terms of the GST impact and you will find that a lot of categories for Varun Beverages, there is a positive impact of GST which they are going to pass on to consumers. And when it comes to carbonated and aerated beverages, where the GST has gone up to let's say 40%, I don't think that's a problem because earlier also the GST used to be 28% plus 12% cess, which directly used to be on the base price of the product, and therefore it's just a cosmetic change is what the management is saying. Of course, we will have to see the numbers coming out of December quarter to make sure that there is no huge impact. But as of now, GST, there is no negative impact. In fact, there is a positive impact because 1/4 of their portfolio is in segments where the GST have come down. Now, a couple of things you need to know about their international expansions. Okay, number one, they have recently set up a subsidiary in Kenya. That is very, very good. Another one, they have entered into alcoholic beverage segment in South Africa using a partnership with Carlsberg Breweries, and that's where they're trying to test the beer market in South Africa. That to me is very, very good if their international businesses can also grow. And lastly, they've recently acquired a company called Twiza, and again, I think that's in South Africa as well. Their intent is to take their market share to 20% by 2027. This deal is quite big. 1119 crores of acquisition is what the company has done. It was announced very, very recently, just 5 to 7 days back. So the volume growth could come from international markets. And when it comes to Indian market, it really depends on what sort of heat waves we are going to see in the summer, or are we going to see monsoon? It really depends on that. But overall, as I talked about their valuations, huge corrections is what I see as of now. Whether it can rebound back, it really depends on their Indian business and how the heat waves or monsoons will play out in the next few quarters. Before I move to my last company, please like this video. Let me know in the comments a simple thank you and also subscribe to my channel. Now let me speak about stock number 5, which is REC Limited. What you see on my screen is the PE ratio of REC Limited. I know it's a lending company and PB will be more important here, but what you note here is that the PE used to be at around 12, okay, in July 2024. It's come down to almost 5.7 now. Median is 4.4 in the last 5 years, still slightly higher than median, but it's a very, very strong correction that you see in terms of the valuations. Price to book, if you look at July 2024, highest at around 2.5. It's come down to almost now 1.1, almost trading at its book value now. Median has been around 0.9 in the last 5 years. Now, if you look at the fundamentals of this company, for example, if you look at the profit and loss account of REC, top line, if you see, good growth rate. I don't see it slowed down at all. If you look at the PAT here, it's growing every single year. Okay. Of course, the growth rate has been slowed down here. If you compare between 20 to 21, almost 80% growth here. Okay. But since then, of course, the growth has been slowed down. It's not growing at a very, very great growth rate. But if I talk about, for example, some of the recent fundamentals of the company, if you look at the first half of FY26, here profits have grown at around 19%, total income 12%, net interest income 15%, loan book growth 7%. This is where I think slight concern is there. Earlier it was growing at around 12%, 13%. It's come down to 7%. That might be one of the concerns here. If you look at the asset quality, very, very good improvements in asset quality. Net NPAs, if you look at, is at around 0.24%. It is lowest, continuous improvement. That is a very, very good thing. Now, if I talk about this company's another factor here, if you look at the FI selling in this company, September 2024, FI used to be at around 21.22%. It's been coming down. Could it be the victim of FI sellings? Possibly. One of the reasons, it's now at 17.97%. Okay. Another point that you need to know about the company is that if I talk about company's dividend yield, it's at around 4.91% at the minute, which is very, very good in my view. It's a PSU that we all know. Okay, couple of government policy related stuff that you need to know. Okay, there was a rumor recently in the market that government had said that they are going to freeze fresh lending for power sector. This was a rumor. Okay, government came out and said that no, they haven't said that. There is no freeze on the lending, because if there is a freeze on lending, then REC, PFC, these sort of businesses will suffer hugely. Okay, the ministry later on clarified that they want to encourage financing for upstream manufacturing stages rather than just the solar modules. So it came out very, very clearly. But one thing that you need to know is in calendar year 2025, because of heavy monsoon and the rains, the power demand had come down. And as of now, if you look at the power requirement in India, coal offtake, one of the metric that can be used, that demand has plunged to 77% in December 2025 and it is running at 2-year low. So maybe that is one of the reasons that sentimentally the power stocks are weak at the minute, but this is very, very cyclic in nature. Again, if next year power demand comes back up, more projects start, companies like REC should thrive. So that's it. In this video, I've tried to cover 5 large companies and have given you latest and greatest about these companies. Please do not take these as recommendations. Do your study as well. And if you want to get timely updates, you can consider joining my YouTube community. There is a lot of content I push out on that almost on a daily basis. I hope you liked this video. If you did, press the like button. Let me know in the comments a simple thank you. I'm going to see you in my next video. Until then, keep rocking.